S&P 500 has dropped 3% in one day today, 5% in 5 days. What should you do? Hi guys, welcome back. As you've probably seen, the stock market is tumbling again. It's dropped 3% just today, the S&P 500, and 5% in the last 5 days. So wanted to make a video about, should you be scared? Should you do anything with it? What should you do? What should you be buying? Should you be selling? So we'll get into all of that. I'll quickly say that there's two trains of thoughts, often more than that in truth, but two main trains of thoughts when it comes to consistent investing. Do you buy the dip or do you dollar cost average? Is this an opportunity where we could possibly do both? So I'm going to run you through, I'm going to go into the laptop and show you kind of a report, an article that I think would be quite interesting for you guys to check out, the difference between buying the dip and dollar cost averaging. If you don't know what those are, I'll quickly explain. So dollar cost averaging is buying consistently. Say you buy into the S&P 500 or an index, you'll buy consistently every single month, no matter what the price is. If it's lower, fantastic. If it's high, doesn't matter. And your dollar cost for that share is averaged out because you're buying at all different levels, but you're buying consistently. Buying the dip is where you'd save that $100, £100, whatever it might be, that you're putting into the stock market. Every single month you save it up, save it up, save it up until you've got an amount of money, and then when it dips you then buy, and you keep doing that. So you're only investing in the stock market periodically, but you're investing much larger sums and at lower points in the market. So you'd imagine that investing larger sums into the market at lower points in the market would result in a better result. But it's not actually the case. So there's a lot of reports been done to show that dollar cost averaging is the best way to invest. Now, if you're a dollar cost averager and you wanted to buy quite soon, because we're coming up to the end of the month and you're going to get paid and you're going to put your money straight into the market, and that's when you buy, and the market's just dropped a little, then why not do that now? And I'm also going to go into a couple of bits that I'd be buying right now to get a great return over time, a safe way of investing, diversifying your money, index funds in a time like this where the market has dropped. There may be fears over certain things, and obviously everything going on and cases rising for coronavirus and things like that are really scaring companies and industries and sectors. If you stick to diversifying your money into an index fund, it's the safest way to be investing your money as of right now, in my opinion. So we talk generally stock market investing, dividend investing on this channel. Consider subscribing to it because there'll be plenty more content coming, and if you are here watching this anyway, the likelihood is that will interest you. Give the video a thumbs up and a like down there if you are getting value from it. So let's get into the computer. I'll show you the article that I was just talking about. Alright guys, so this is the website I wanted to show you, or the article I wanted to show you. There's plenty like this, and the graphs will be very much the same, but this is just the first one I came across and read, and it was quite interesting. It's ofdollars-and-data.com. Even God couldn't beat dollar cost averaging is the article. And this is the main bit. So the main graph I wanted to show you. So we've got buy the dip investing versus dollar cost averaging. Dollar cost averaging in black, buy the dip in blue. So this is from 1974 up to 2075, up to 2014. So dollar cost averaging, as you can see, has always just been a better way to get into the market, because you're getting into the market more consistently every single month, rather than waiting and your money's doing nothing or actually losing value, and then you put it in, then it does something, but your money's still doing nothing the next time, where you're waiting again, rather than your money always doing something. And on rises like this, your money's constantly being put in and put to work, which is why it ends up higher. And it's just consistency. Like with anything, consistency is key. And then up in 2014, where it's such highs there, you know, because consistently the money's been put in and put to work. So anyway, that was just the article I wanted to show you. It's quite interesting, some graphs on it that are quite compelling and are quite easy to read and see. Let's get into the, I've got my portfolio open. So again, with complete transparency, I'm over 2,000 down. As a lot of you may know, I started investing late last year. So put all my money into the market in all-time highs, but it's okay because dollar cost averaging, it will all balance out and I'll be better off in the end. So we're £2,000 down. Let's get the S&P tracker up, the Vanguard, ticker symbol VOO. So that's what it's done. 12th of October really is where it was at highs again. We've had a couple of dips. Get some money in now because we're at potential lows, or will it go lower? Who knows? Nobody knows. I personally think it may continue to go lower. I think the market's going to carry on down for a little while, certainly, until we get a good news story, and then it'll go up again and then it'll go down. But I think it's going to just slowly but surely trickle back down now as cases start to rise again over in America and all over the world really. But it doesn't matter, get the money in. Get the money in now, get the money in next month, get the money in the month after. So this is what I'm going to be doing. I'm going to stick probably for the moment half index fund where it's diversified for me, probably the S&P 500 Vanguard index fund, ETF, exchange trade funds, probably some sort of aristocrat, good paying dividend, maybe something like AT&T. It's always been my favourite, or one of my favourites, and we've seen again another little slump. So it could be an AT&T this time around for me. It could be a monthly payer mortgage REIT, something like AG&C, actually on its way kind of back up again. Fantastic yield at the moment, small dip today. Or it could be something completely different. I don't know for sure, but certainly without fail, it's going to be an index fund of some sort, and it will probably be a Vanguard index fund, and it will probably be the Vanguard S&P 500 index fund. That's the article I wanted to show you. That's what I'm going to be doing probably in the market, certainly buying an index fund of some sort to diversify my money. Nice, easy, safe way of investing. It's got to be one of the safest ways of investing and one of the most passive forms of income. So that's it guys, I'll throw you back out there. Right, so I hope that was helpful. I hope that was good to see exactly what I'm going to be doing and what I'm going to be getting into. Doesn't mean that you should be by any means, but that's just what I'm going to be doing. And hopefully that's giving you a bit of a transparent look into kind of the market and actually maybe the best way to navigate the market. Diversifying your money in times like this. Hopefully it maybe gives you a bit of an insight and a bit of confidence in the stock market as well, rather than seeing all this negative news and bad news and all these thumbnails. I put them up here of crashes and this, that and the other, much like the thumbnail I've done for this video, hypocritically. Wanted to get you in here and give you a bit of confidence in the market to show you that actually you should still be investing in this market. You shouldn't just, it dips so you're just going to sell out. You should be in this for the long term, and you should take this opportunity to buy some really good quality index funds or stocks, individual stocks at a discounted price maybe. Just show you with again complete transparency what I'll be doing. So you can kind of live vicariously through me maybe, but also start gaining the knowledge and the confidence to get into the market yourselves. So as I said, if you've got value from this, consider subscribing to the channel and give it a like if you have enjoyed what you've watched so far and if you've made it this far. So pop a comment down below what you're getting into, what stocks you're going to be getting into, what index funds you might be getting into, and we'll have a little conversation about it. But until next time, I'll wrap it up there. Keep investing, and I'll catch you guys in the next video. See you later.